Have you ever wondered why, despite everything screaming danger, the numbers just keep going up? Because here's the truth. When you look at the valuations, when you look at the debt levels, when you look at what happened in every bubble before this, the crash should have happened already. But it didn't. And that's not luck. That's not a miracle. That's a system designed to keep you in the dark. The banks, the institutions, they know something you don't. They know why it's still standing. They know what's really holding it up. And more importantly, they know exactly when it's going to fall. Once you understand the real reason, you'll never look at the market the same way again. So stay with me. By the end of this, you're going to see what they've been hiding. And trust me, you need to know this. Leave a like and let's start now. Let me show you something that'll make your head spin. The data doesn't lie. There's a metric that serious investors use to measure whether markets have lost touch with reality. It compares the total worth of all publicly traded companies against the actual size of the productive economy. Right now, that ratio sits at 216%. Think about what that means. For every dollar of real economic output, there's more than $2 of stock market value. Anything over 100% signals overvaluation. Back before the tech wreck in 2000, we hit 115%. The result? A 60% collapse that wiped out trillions. Today, we're not at 115. We're not even at 150. We've blown past 216. By that measure alone, we should be watching the rubble by now. But there's more. Look at the price-to-earnings ratios of the biggest companies driving this rally. They're trading at 66 times earnings. In a normal market, healthy companies trade between 15 and 20 times earnings. Even growth companies rarely justify more than 30. But 66? That's investors paying $66 for every single dollar of profit. Imagine walking into a store and paying $66 for a sandwich worth one. You'd think that's insane. Yet this is happening every single day in the markets, and the buying continues. So here's what we need to understand. If the numbers are screaming overvaluation, if history shows markets crater at these extremes, if even the smartest investor alive is holding cash instead of buying, then why does this keep going up? The answer isn't obvious, but once you see it, everything clicks. Let me explain how cycles normally work. Markets move in waves. Early on, optimism builds, money floods in, prices surge. Then smart money sees the disconnect. They exit. Fear spreads, selling accelerates, prices collapse, bargain hunters step in at the bottom, they buy, the cycle restarts. This has happened for generations, but now something's different. We're at extreme valuations, yet the big institutional players aren't panicking. They're not dumping everything. They're still positioned, still in the game. That tells us something critical. There's a force underneath this market that's keeping it propped up, something most people don't see. Something powerful is happening beneath the surface. Here's where it gets interesting. The biggest force holding this market up isn't innovation or productivity. It's government spending on an unprecedented scale. A continuous flood of public money. Washington collects roughly $5 trillion in taxes every year, then immediately injects it back into the economy. Social Security payments, Medicare reimbursements, defense contracts, debt interest. That money flows into households nationwide. And what do people do with it? They spend new technology, restaurant meals, fuel for vehicles. All that spending becomes corporate revenue. The same corporations driving stock indices. But here's the critical part. The government doesn't just spend what it collects. It overspends by at least $2 trillion more annually. Borrowed money, debt pushed to future generations. That extra capital pumps through the same cycle, becomes paychecks, converts to consumer spending, transforms into corporate earnings, gets capitalized into stock prices. So the real question isn't why the market hasn't crashed. The question is, why is the government running deficits this massive? What's driving this spending machine? Because once you understand that, you'll understand why everything still stands and why the banks never want you connecting these dots. To understand why, you need to zoom out and see the geopolitical reality. Since the end of World War II, the United States built and maintained global dominance. It became the industrial powerhouse, the technology innovator, the financial command center. If you wanted military protection, you operated within the American framework. If you wanted access to international capital markets, you followed American rules. If you wanted cutting-edge products and services, you integrated into the American system. For decades, no rival came close, but that ERA is ending. Nations like China, India, and others are ascending rapidly. They're constructing alternative systems, building independent militaries, developing their own technological ecosystems. They're declaring they no longer want dependence on American infrastructure. This shift directly threatens American supremacy. So Washington made a calculated decision: spend whatever it takes, borrow from tomorrow if necessary. Run deficits that would have been unthinkable a generation ago, because the priority isn't fiscal responsibility. The priority is maintaining dominance while this new multipolar order crystallizes. The belief is simple: flood the system with trillions now. Stay dominant while competitors are still building. Secure the position before the dust settles. Now, here's the mechanism the financial establishment doesn't want you to understand. When governments flood the system with borrowed trillions, they trigger monetary devaluation. Let me make this clear. Imagine an economy with only $10 in total circulation. Those dollars carry real purchasing power. Now suddenly double that to $20. Each dollar is now worth half as much. That's inflation. That's currency devaluation. And it's happening to the American dollar right now. This is why markets haven't collapsed. Investors aren't betting on corporate productivity. They're betting on monetary debasement. They understand the dynamic completely. As the dollar weakens, corporations raise prices. Reported earnings climb, not because companies produce more, but because nominal prices increase. This makes today's absurd valuations appear rational later. Here's a concrete example. A company sells a product for $100 today, earning $10 profit, earnings equal 10. But if inflation pushes that price to $200, earnings double to 20, even though actual productivity hasn't changed at all. That's the hidden engine, not genuine growth, not real innovation, a continuous bet on purchasing power destruction. But this creates a catastrophic consequence: explosive wealth inequality. Who owns most equity markets? The wealthiest 10%. The bottom 90% hold almost nothing. So as currency value erodes and stock prices inflate, the wealthy accumulate exponentially more. They're completely insulated. They benefit from asset inflation. Meanwhile, the 90% without substantial investments fall progressively further behind. Their wages don't keep pace. Food costs more. Housing costs more. Transportation costs more. The wealth divide expands exponentially. This is what the establishment desperately wants concealed. They don't want you recognizing that market gains rest fundamentally on currency debasement and structural inequality. They want you believing everything is healthy, that growth is organic, that nothing is wrong. But reality is different. This system is artificially sustained through monetary manipulation. The markets aren't rising because the economy is strong. They're rising because the currency is weak, and the people holding assets benefit while everyone else pays higher prices for everything. That's the transfer happening in plain sight. Wealth flowing upward while purchasing power flows downward. And eventually, this imbalance will reach a breaking point. When it does, the correction won't be gradual. It will be severe, because you can't indefinitely prop up asset values while destroying currency purchasing power. Eventually, economic reality reasserts itself. The most sophisticated investors already understand this dynamic. Take someone who's consistently outperformed markets for decades. He's currently holding unprecedented levels of cash. Why? Because he recognizes this game has an expiration date. He knows when the inevitable correction arrives, it will be severe, and he's positioning himself to acquire quality assets at depressed prices, exactly as he's done in previous cycles. He's exercising patience because he understands cycles always complete. So what does this mean for you? You cannot afford to remain passive and hope circumstances improve. If you take no action, your purchasing power will continue eroding as monetary devaluation accelerates. However, if you make informed decisions, if you allocate capital into appropriate assets, you can preserve your wealth and potentially expand it, even in this distorted environment. But understand there's no neutral position. Inaction equals accepting loss. This is the concealed truth behind market resilience. It's being sustained by unprecedented government deficits, by borrowed capital on an extraordinary scale, by deliberate currency debasement, and by the strategic positioning of elite investors executing a long-term strategy most participants don't recognize. It's a framework that functions in the present, but it lacks sustainability. The question isn't whether collapse arrives, but when. And when it does, those who prepared will capitalize. Those who ignored the warnings will suffer the consequences. That's why it's essential to see this system clearly, to reject the illusion that conditions are normal, and to make strategic decisions now that protect your future. Because the financial establishment may prefer you remain ignorant, but now you understand the reality, and the power to act is yours. Share your perspective in the comments. Subscribe to stay informed on these developments, and I'll connect with you in the next one. One final note. I'm not providing financial advice. This content serves educational purposes exclusively. Any outcomes depend entirely on your own decisions and actions.